Businesses exist to create value and to receive something of value in return. So what's value from the standpoint of a business? If I'm creating a business, value is what customers are will willingly pay for, right? Excuse me? A product, but a product is something, if you think of the product just as a product, sometimes what you're thinking, you're thinking too small. So let's think about smartphones, right? What's that a picture of up there?
iPad.
An iPad. Okay, I had, years before the iPad was released, I had a Hewlett-Packard notebook computer that had tablet characteristics. I could turn it over, lay it flat with the screen face up. I could draw on the screen, do a lot of things with it. And I spent, I don't know, $800 or $900 for it. It was okay, but it didn't sell like the iPad. Were there tablets out before the iPad?
I think they were.
Yeah, there were some devices. Okay.
Mobile computer.
Okay, but what happened was they found, Apple always does this, at least in recent years, they find a way of adding value, so they'll bring in people, they're early adopters to new technologies that will buy things. But what Apple's been good at is taking sort of a relatively new technology or a technology that hasn't caught on in a big way and turning it into something that's just mass market where everybody wants it. Does that make sense? iPhones, smartphones. A lot of people who would have gone with just the simple phones, they switched to smartphones because there was value added for them as a result of all these features that were on an iPhone, right? And a lot of the competitors were blown out of the water because they thought of a product. Okay, we'll give them a phone, we'll give them the stuff that used to be on the personal digital assistants, we'll give them a few features. Apple went way beyond that. And the basis for that was iOS and smart people thinking about things. Now, one of the things Michael Porter came up with, can we stop for just a second? Okay, so Michael Porter, as an academic, decided to look at what companies do, what activities they engage in that add value, things that the customers are willing to pay for, and the activities the company engages in that are support for making sure that these activities that add value can exist. Now it sounds kind of theoretical, but it makes sense when you think about it. People are willing to pay for, let's say you could be a retailer or a manufacturer. People are willing to pay for you to get the materials you need to manufacture something, right? So they're willing to pay for inbound logistics. They're willing to pay for manufacturing the product. They're happy to pay for that. Or for refining the oil and creating new products. They're willing to pay for you to ship something out. They're willing to pay for marketing and sales because that helps build the brands, and we'll talk about that. And they're also willing to pay for service. They're happy to build that in. But if you're spending a lot of extra money on transactions to procure things, they're not so happy about that if that drives up the price. And what happens if your price gets too high and it's a product that other people can produce?
Nobody buys.
Either people buy less or competitors come in and they say, hey, I can procure, I can manage this process cheaper than anybody else. And also, I can reduce the cost of the primary activities. That's Dell Computer. Where did Dell Computer start? It was in a dormitory. Yeah, Michael Dell was in college, and what he did was he would take orders for computers to build computers, and he'd take the money, and then he would, at least this is the mythology, he would take the money, he had the money before he actually had people build the computers, and then he would ship them. So he didn't have a lot of inventory and other things. So what Dell Computer has a very lean value chain, and they've been able to reduce the costs of some of the support activities. They've also reduced the costs of the primary activities for them. And that's why I could buy a Dell computer for about $800 less than I could buy any other computer the last time I bought a Dell, the only time I bought a Dell, at that time when I was visiting California. I think that was 2007. Exact same components, but it was $792 less than from any other vendor that I could find and I was in Silicon Valley. Okay, one of the things that's important here is marketing and sales, and this is one of the things that gets overlooked often in Russia. For some reason, a lot of Russian companies don't think advertising and other marketing activities really matter, and they don't seem all that willing to put a lot of money into them.
They don't know how to do it.
That's part of it, and so that's an opportunity for a lot of you in here in the future, right? But they have to be convinced that it matters, but marketing does add value. These are some brands that are really, really good at marketing. And we see a couple of lifestyle brands, you know, brands that say something about you as a person when you use their products. Apple is considered a lifestyle brand. Harley-Davidson is considered a lifestyle brand. Starbucks, maybe to some extent, excuse me? Nike, yeah, Nike, okay, I didn't have them on here, I just found a few. Hugo Boss, it says something, you wear a Hugo Boss suit, it says something about you, right? But these are people and companies who have designed products that other people could design something similar, but people have a real affinity for them, right? And part of that, a big part of that, is just really good marketing. And we could have BMW and a lot of other companies on there. So one of the things that's a purpose for value chain analysis, or a few of the things, are first of all, determining where you actually add value to customers. And one of the things we'll talk about in the future is controls, and looking at how much you're spending to do certain activities, and that's important, particularly with the new WTO world that Russia's about to enter. But ensuring that you're actually adding value for customers and other stakeholders. Who are other stakeholders for a company?
Everybody who's involved in
The investors?
Yeah, everybody who's involved, so it can be the investors, their stockholders and stakeholders or shareholders. Okay, it can be the local community, it's customers, it's workers, it's a lot of people. It's people who are affected by their success because it might determine whether there will be other businesses that are effective in the community. Another part of it is eliminating unnecessary activities. Now this is something, there's going to be a lot of this in companies in Russia coming up. Historically, and you can talk to some of my colleagues here who work with human resources, and they'll tell you a lot of these companies are saying that, yeah, you know, we've got people, we've filled the slots, but we're really not getting much done with the people, right? They're not all that productive. So a lot of companies in the new WTO world for Russia are going to start looking at what activities are unnecessary. They're going to start walking through all the processes of the company. And so that's one of the things you can be thinking about as you're doing value chain analysis for your company ideas, but also as you're looking at your own company and other companies, right? Okay, and then reducing costs, very important. We talked about this a bit last time, and this is the VRIO framework. It's considered a resource-based approach to looking at the company's strengths, principally strengths, right? And so what you do is you look at resources that the company has, and it can be certain departments, it can be patents, copyrights, it can be the CEO. It can be a chief information officer, it can be any number of things. And what you do is you look at a lot of these different resources that are important to the company, and you determine, first of all, are they valuable? If they're not valuable, then they're a disadvantage because you've got a resource that has no value. What are you doing with that? Make sense? If it is valuable, but it's not rare, then you've got a resource that gives you parity with competitors. Parity means sameness, right? Equality. Okay, I mentioned an example last time. What was that when we talked about parity? America, a hamburger stand, right? Now, I could go out and start a hamburger stand. I could sell hamburgers. Is that valuable? Yeah, will customers pay for it? Yes, but is it rare? No.
Menos McDonald's.
I mentioned McDonald's, a Big Mac, is that valuable? Yeah, they sell billions of them. Is it rare?
Yes.
Yeah, it's protected by patents, right? And so people go there, they're jonesing for a McDonald's hamburger. How many of you like McDonald's French fries? Anybody? A lot of people in America, they love McDonald's French fries. Those are patented, right? Those are valuable, they're rare. There are people that are walking along and they start, we say jonesing, they're feeling like, I need some McDonald's French fries. Now, I'm not real big on that kind of food, particularly as I get older, but a lot of people are. How about Coca-Cola? Their formula. A lot of people, I can't tell the difference. Cola's cola to me. But for a die-hard Coca-Cola or Pepsi drinker, there's clear difference. So they've got a valuable, bit of sugar water, and it's rare because it's protected by copyrights in that instance. Sometimes there's a company that has, I invested in a company, Pretium Resources, because they have a CEO who was really good, who built up another mining company, Agnico Eagle Mining, and he built it up to being a very strong company and then split off and took some resources with them. And so I invested at the suggestion of somebody who I really respect in that company principally, and so did a lot of people, principally because of the CEO, because it looked like this is a person who can manage a mining company and make money. Okay, moving on. Then let's say it's valuable and rare, but it's not costly to imitate. What did I use as an example last time for that?
Apple.
Actually, I think I used for that Sony Walkman, remember? Okay, so Sony came out initially with the Walkman, and this is an example from the textbooks. They had the Walkman. Was it pretty easy to imitate that? Was there anything really proprietary about it other than the brand? No. So you could go to the bank and open a bank account and they'd give you a Sony Walkman looking device and you'd call it a Sony Walkman, but it wasn't, it didn't say Sony on it. And so there were a lot of other companies that could come in with a similar device, right? So it was easy to imitate, but some people still paid more and they bought Sony. And we'll talk about differentiation strategy a bit later. Okay, so it has temporary advantage. Sony eventually had to lower its prices some for the device because there were other devices and people started getting price sensitive about buying a portable tape recorder. Okay, and then finally, if it's valuable, rare, and costly to imitate, and you are organized to take advantage of it, an iPad, a Harley Davidson, right? The design of the motorcycles, then those are, and the brand and a variety of other things, then those are things that can give you sustained competitive advantage. Does that make sense? Okay. So one of the things you want to look at is, what do the competitors have as you're looking into your business? Do they have anything that gives them, do their resources give them sustained competitive advantage? And are there any things about your perspective company that could give your company sustained competitive advantage? Okay, let's talk about the next step, which is, this was internal analysis, looking at strengths and weaknesses, evaluating resources, value chain analysis for the corporate value chain. Let's talk about external analysis. Now, we talked about external analysis helping us to determine what the opportunities and threats are. It also helps to determine if there are above normal profits likely in an industry that you might enter, or if you're already in the industry, whether you should stay. What industry did IBM get out of in the last several years? It's one they helped build up. Anybody remember?
Emergency office.
That I'm not sure of, but I was thinking personal computers. They sold off their ThinkPad line to Lenovo, and as far as I know, they sold off their whole personal computer line to Lenovo. And they got out of that business. They still do servers and other types of higher end computers, but they decided that there was so much competition that the margins were too low. So they didn't want to compete there. They thought they could make better margins in other businesses, including consulting, design of whole systems, and servers and that kind of stuff. Okay, so it helps you to see if there are above normal profits likely in an industry. It also helps you to understand the competition in the industry. What's it like? And are you going to be able to survive that competition? Are there threats and are there opportunities? And also, you can make better choices strategically. Now, we talked last time also about the industry value chain. Remember that?
Yeah.
Okay, and what's the idea of the industry value chain?
But you can be closer to the potential client, actually. Not start from the very beginning of the chain, but in case if you have some features, you can sell your product directly to the final client.
Oh, okay, good. Yeah, so you might look at some steps that you can cut out of the value chain. And the industry value chain is the set of value-adding activities that make up an industry. And I've only seen a couple of these industry value chains, and I've mentioned last time, I've tried to look for more. It seems like you've got to pay a lot of money to get them, and I'm not sure what I'd be getting. So most of our students, when they're doing their diploma papers, they estimate or they try to determine what the industry value chain is for their particular business, and I usually give them some advice too. But I haven't ever run those past anybody else to see what they think. But notice here, for the petroleum industry, it starts with exploring for crude oil. Now, most of us don't want to go doing that, right? We're going to pay somebody else to do that. We're going to pay somebody else to drill for the crude oil. We're going to also pay somebody else to pump it, ship it, buy it, refine it, sell the refined products to distributors, and ship the refined products. We're down here at the retail end, most of us, right? Now, there are some companies that are fully integrated. They do all of this stuff, right? And there are some companies that just do one part of it. There are companies that buy crude oil and resell it, just like there are companies that buy energy and resell it. They're middle people. That was Enron. Enron was an energy purchaser. They started out as a natural gas company, but they were a middle person. So in some cases, there are still small companies that are just buying or refining crude oil. As you look at your business, you want to know where you want to know the whole value chain for your industry, but you also want to know what steps in the value chain your industry is competing in. And you may be competing against giants who are fully integrated, or you may be competing principally against people, you may be a niche player, right? Principally competing with people at the same level. You know, there might be other companies. And one of the things about a value chain, too, is it tells who the suppliers are and who the customers are. So if I'm pumping crude oil, my suppliers might be people drilling, right? They come, they drill, and then I set up my pumps. And my customers are going to be people who are buyers of crude oil if I'm a small operator. Now, this is a pretty consolidated industry. Okay, so you want to understand the value chain for your company. You want to understand who the customers are and also who the suppliers are. Okay, and here's another value chain, an industry value chain for a product-oriented organization. And it also starts with crude oil. But here, notice there's another concept. Here they manufacture plastic kitchenware, then it goes through wholesalers, there's packaging, there are retailers, and then there are the final customers. So notice here at manufacturing, there's a break here. And you'll hear companies or you'll hear business people talking about upstream and downstream. And upstream, generally, you're talking about upstream closer to raw materials. And downstream, you're talking about closer to the final consumers. So those are concepts that you often hear, upstream and downstream, and you're thinking, what are they talking about? Well, now you know. Okay, so simply put, the top of the value chain for many industries is raw materials. Middle of the value chain is manufacturing. After manufacturing, there's often historically been distribution. And the benefit of distribution, you discussed this in marketing, remember? Okay, the benefit of distribution is if I'm a manufacturer and I've got to talk to every customer who's going to buy the finished product, that's a lot of contacts. And if I'm a manufacturer, maybe I'm not good at that stuff. What I'm good at is manufacturing, right? I'm not good at making the contacts. A distributor, on the other hand, can can reduce by at least a third the number of contacts that are having to be made in order to get that same number of customers. And if those customers are dozens or thousands of other distributors or of retailers or something, then it makes a big difference. But technology's changed that, hasn't it? And we'll see that in just a minute. Okay, so here are some distribution channel schemes. You might have seen this in marketing as well. Remember, there are the direct channels. Manufacturer go to direct to the customer. And there are a number of companies that do this, particularly with B2B type companies. Okay, then there's an indirect channel from manufacturer to retailer to the consumers. And some of the big retailers have tried to develop this system. They've been very successful at this, so they've eliminated the middle person, the wholesaler, right? Okay, and so the third one, another model is manufacturer to wholesaler to retailer to consumer, and then finally manufacturer to wholesaler to jobber. And a jobber is usually somebody who's a smaller, they have smaller clients. So it might be somebody here, a jobber might be a distributor who puts together packages of supplies, of inventory rather, for kiosks, right? So instead of packaging it for large supermarkets, what they do is they package it for kiosks, or they package it for small manufacturers if you're using manufacturing goods. Okay. And then at the bottom of the value chain, of course, the retailers. And we see British Petroleum, they have stations here, do they not? Did somebody say they have? Okay, and I haven't seen one that I recall, okay. And then Walmart. Walmart has been the king of retail. Now, retail is changing, isn't it?
Yeah.
Here's an example, and I mentioned this last time too. When I was a kid, you know, buying Pink Floyd and Emerson, Lake and Palmer albums and like that, Grateful Dead, I was going to Tower Records much of the time. And they were everywhere. And you know, you go in, it was sort of a scene. You go in, you hang out, you look at all this music, some of it's really cheap, and they had records originally, and then tapes, and then CDs and like that. What happened?
Technology's changed.
Technology changed. Initially, Napster, right? Remember Napster? File sharing? Okay, so basically what happened was all this music, this protected property, this intellectual property was being freely distributed. So somebody had to come in and make sure that the record labels could still make money and the artists could still make money off their product, right? And so that was iTunes, and who is that? Apple. And what was Apple called before?
Apple computer.
Apple Computer. And what did Apple do? What was their principal thing? Computers. And yet, they were the ones that came up with the idea to do an online store to sell music, to package music, to sell one song at a time. Now, who else could have done this if they'd been really scanning the environment and looking at the opportunities? Well, Tower Records could have done it, right? But they just gave their whole business away and went bankrupt. Who else could have done it? How about the record labels? Why didn't they just do a mutual services consortium, all get together and agree to put their money into investing in a company that would do exactly this? So one of the things a lot of suppliers and customers of Apple, the business customers don't like about Apple, at least in the papers, you know, in the press, is they say that Apple squeezes all the money they can out of all their products. So the record labels aren't all that happy about 99 cents a song price, since they're only getting a small share, and I honestly don't remember how much it is. But it wasn't that great for them, but it was a lot better than Napster, right? But this is something, if they'd been smart, if they'd had people working for them, then they might have said, let's Sony and Capitol and some of these other records companies, they might have gotten together and just set up their own store, right? And sold direct. These opportunities were out there, but now what's the point? What's the point in competing with this? What else did Apple do that was smart with iTunes?
App Store.
Okay. They've got an app store now. The other thing they did, when I became familiar with iTunes, principally because I got an iPod. And so my iPod it's one of the first, it's either the first or second year, and I've got 30 some days of lectures and music and other stuff on it. You know, it's great. But I use iTunes to synchronize with it, and I use it for listening to music and some other things as well. Anyway, the point was retail's changing. So what we're seeing is what's called disintermediation. A lot of the middle people are being removed. And so if you're going to be a middle person, if you're going to be a wholesaler or even a retailer now, you have to add some value for the customers. So, new economy, new value chains, fewer levels in the value chains, fewer companies, and a big focus on corporate value chains, reducing costs, reducing unnecessary activities. Okay, we talked a bit last time about environmental scanning. Remember PEST? What does that stand for?
Political, economic, social, and technology.
Okay, political issues that might affect an industry, economic issues that might affect an industry, socio-cultural industries, and there are different ways of saying this, and technological factors that might affect an industry. We saw some technological factors earlier. Those were also impacted by some sociological factors, right? iTunes could exist because people were buying computers and iPods. The record industry would have had no problem if nobody had computers, right? But suddenly people had computers. They were also going on the internet. And I got on, like personally on the internet in 1995. And I was not an early, there were people before me, but I was sort of on the big wave going in. My mom was on by probably 1999 or something, 1998. She had her own computer. Okay. So here are a few of the things, and this is in your syllabus as well, but some of the factors that you're looking at. Economic factors. Now, these are just some generic ones. What are some things that are happening economically and politically in the world right now? Tell me some political things that are happening that could have a big impact on Russian markets. How about WTO? That's political. Will that have an impact? Yeah. What are some of the impacts that can have?
Unpredictable, unfortunately.
The president election, like in France.
Well,
President election.
That's another political thing, but let's just talk about WTO, accession to WTO. What are some obvious things that are probably going to happen?
Reducing the price for the imported goods.
Reducing the price of imported goods, which means people may buy more foreign goods, which may or may not be a good thing. Now, if you can be a distributor of those and not be cut out, then maybe that's a good thing. But if it's possible to buy foreign goods relatively direct, then maybe that's not a good thing, right? If you can cut out some of those layers because there's not that much money, there's not that much added value it's being paid to people in Russia, right? Okay, what are some other things that are going to happen, do you think? It's going to affect the competitive environment here.
Market expansion.
Okay, let's go further.
And competition.
Yeah, a lot more competition from some companies that have been working in the West. Are they pretty good at what they do? A lot of these Western companies? Yeah. And if they're getting easier access to the Russian labor market and to Russian consumer markets and business markets, does that make it more difficult conceivably for Russian businesses to compete? Yeah, it can. And the other thing that's happening also is that there's consolidation in industries. So more and more companies, there are more mergers and acquisitions, and there are also companies that are just falling off, right? Okay, how about economically? What are some things, well, let's talk about politics some more, and this is sort of socio-cultural and economic. What's going on in Greece? They've had a crisis, they're on the verge of default, they just had an election, they couldn't form a government, they're going to have another election. A lot of the left and right parties that are not going along with giving the bankers back the money that was borrowed, that's created, you know, at the time it was borrowed, it didn't exist before, but for the most part. But the bankers want it back with interest, right? But what are a lot of the citizens saying? No, and a lot of the citizens aren't willing to pay their taxes anymore, so there have been uprising, that's the uprisings, that's sort of socio-cultural and political, right? Now, what are some things that can happen as a result of that? What are they talking about?
They will go out from Eurozone.
They may go out from the Eurozone. What are some other countries that may follow them or relatively close behind?
Italy and
Spain
Spain.
Italy, Spain, Portugal?
Portugal.
Mhm. And Ireland, maybe. Ireland's apparently a little more stable. Okay, Britain's not doing that great. Belgium, I've read, isn't doing so great. So those are some things you'd want to keep an eye on, right? If you're doing analysis for your business looking at the future, how could that affect Russia? Let's say 3 or 4 countries leave the Eurozone. What could happen to the euro?
It will really affect it because of the decrease for the oil prices.
Mm-hmm.
You know, because of unpredictable situation in the Europe, there is always a decrease in demand for the oil, and this was the direct reaction of the Russian market to these events in Greece.
Okay, good. So already the Greek crisis and the crisis in the pig nations, which are the Portugal, Ireland, Italy, Greece, Spain, that's already impacted the demand for oil from Russia.
Yeah, and in addition to it, as a second step, all Russian blue chips went down.
Okay. Yeah, and we're seeing, things I'm invested in aren't looking so good now. The stock market's going down. That means I have less wealth, right? And gold and silver, I'm invested in that. That means I have less wealth, at least on paper. I haven't sold it, so, you don't realize it. But that affects me. And that affects a lot of other people. The dollar's gone up a bit against the euro. The dollar's gone up again a bit, at least I haven't looked for a few weeks, but it's gone up a little bit against the ruble as well. Because apparently, for some bizarre reason, people are buying dollars. They're leaving, I guess, the euro, or at least that's what we would be led to believe. Okay. So those are some political things that might affect this market. And if you're going to start some businesses, what you may want to do is look at starting businesses that are going to be purchased by other Western businesses that are going to come into this market. Who was a restaurant holding company that did that here in Russia?
KFC.
Yeah, KFC, which was Raw Center, right? Raw Center, they did Raw Sticks, and it was quite successful. I don't think I was ever at a Raw Sticks where I didn't wait in line. And they were quite successful, and they were able to sell it to KFC. They tried to get a deal with KFC, 15 years ago, and KFC wasn't interested. Well, they bought them. And sometimes that's what you do. You build the business to sell it to somebody else. I often thought that's what Shokolobnitsa was probably trying to do with Starbucks, because they bought up all these good locations, which was typically what Starbucks would do. So I thought maybe they were trying to get bought. It doesn't appear. Okay, then there are socio-cultural things. What are some, how about in the food industry? What are some things that are happening here related to food? Well, one thing,
Sushi.
excuse me?
Sushi.
Sushi, yeah, that's a big thing. And okay, so welcome back to Advanced Entrepreneurship. And tonight we're going to talk about creating a solid financial plan. And most of this class is going to be spent actually doing some work. Now, all of you have had some classes in accounting. Some of you had your first course in accounting taking our GAAP class, Generally Accepted Accounting Principles class. So some of this you already know. What I want us to get used to doing is the concept of building up the financial statements. Now, you understood how to do that with different accounts and developing different cost structures. And so in this class, we're going to emphasize budgeting. And we have software that we'll be using to do that. The software we have is a great software package from Palo Alto Software called Business Plan Pro. And it's really user-friendly, and it helps think through a business plan, and it also helps a lot with doing the financials. Tonight we're going to emphasize the financial planning aspect. So we'll use the software just to set up a financial plan, and I'll talk about that a bit later. Before we do that, I wanted to review a bit the financial statements, the 3 principal financial statements, and I'd also like us to look at some business ratios, some common business ratios. So, what are the three principal financial statements? Do you remember? The what now? Income statement, okay, also called profit and loss. The balance sheet, okay, also,
Cash flow.
and the cash flow statement, okay. And sometimes you'll see the income statement called the profit and loss statement, or excuse me?
European.
P&L,
Generally
okay.
in European countries.
Okay, good. And you see that sometimes in the States as well, and that's actually what they call it in Business Plan Pro. And you'll also see the balance sheet sometimes called the statement of financial position, okay? You'll see that, so if you hear those, in fact, one of the things to be aware of when you look at financial statements, often the line items will have, there will be multiple names for the same line item, and so you have to remember which is which. And so there are 10 names for, not 10, that's an exaggeration, but there are several names for some things. We're going to run into that tonight as we start going through some of these ratios. Tell me about the income statement. What does it tell us?
Company profitable or exactly the opposite?
Ultimately, it tells us whether the company is profitable or not.
Or not.
What else does it tell us? What leads us to that?
Revenue?
Revenue and expenses, okay? So it tells us the revenue and expenses based on the particular accounting procedures that have been chosen for that company. And remember from accounting that depending on the accounting procedures you use, there will be differences. Using the same facts may create a different set of circumstances in the accounting, in the financial statements. So in this case for the income statement. So depending on whether you use LIFO, FIFO, or average cost method for inventory, right, then it will look a bit different because the cost of goods sold will be different. And therefore ending inventory will be different, right? Okay, and where does ending inventory go? Where do you see inventory generally? I mean, you will see it on the income statement sometimes if they've got the periodic inventory system, so you'll see it as a part of the calculation for cost of goods sold. But where do you see inventory uniformly? Which financial statement?
Income statement.
No.
Balance
Balance
sheet.
sheet.
Yeah, the balance sheet. And inventory is what kind of an item on the balance sheet?
It's type of assets.
It's a type of asset. And what kind of asset? Is it short-term or long-term? Short-term. So the expectation is short-term assets can be converted to cash within how long? Within 1 year.
1
So
year.
under a year. Short-term assets are things that can be converted into cash within a year. And they may not be. Sometimes you'll have something in inventory that lasts more than a year. But the idea in general, from an accounting standpoint, you treat inventory as something that would be a short-term asset. Now tell me about inventory. Is this inventory from an accounting standpoint?
No.
No, what is this?
Asset.
It's an asset. What kind of an asset?
Operating.
No. How to say?
Could be.
It's
You-
office supplies.
Well, this wouldn't be supplies so much. This would be a fixed asset normally. So supplies often are short-term assets, remember? But this would be something that's considered a long-term asset, and it's probably equipment. You know, you'd put it in under equipment. You might put it, for us, we might have a category of equipment and furnishings. That would include computers and tables and the projector that we use, that kind of stuff. Okay, and is that a short-term or a long-term asset? It's a long-term asset, okay? And what's the idea of long-term assets?
They depreciate.
Yeah. In many cases, they depreciate. Many of them, equipment depreciates, buildings depreciate. Does land depreciate? No, land doesn't. If it's land for extraction of coal or oil, though, right? If there are resources, then what do you have?
the amount of resources is decreasing.
Right.
So,
Okay. So as you extract the resources, then that's accounted for. Okay. All right. So, and it's called depletion, by the way. Depletion. Right? So, and you deplete at a certain rate based on actual usage of the resources, and the land has some value at the end, salvage value. Now, we're going to look later at depreciation. That's part of what you'll be doing. The first part of, in fact, the exercise we do for Business Plan Pro is calculating some depreciation for equipment. What is depreciation again?
Oh, lost of the
Loss
value.
of value.
It's reducing the value of a fixed asset or a long-term asset that's depreciable. And what's the purpose of it?
Depreciation.
To calculate the final value.
Well, ultimately, you have a salvage value, okay, but the idea is that if I buy this computer and it's gonna last 5 years, should I take, let's say I buy 100 computers or 1,000 computers, should I expense all of those in 1 year? Does that reflect the usage in terms of generating revenue? No, it doesn't. So what you wanna do is spread the value or the cost of those, that expense, you want to take that cost, that overall cost, and expense it over a few years to give a more accurate picture. And it's not a perfectly accurate picture, there are just accounting conventions for depreciation that are accepted, right? So if you have vehicles, you may choose to depreciate a vehicle over 3 or 4 or 5 years or 10 years, whatever it is. Some companies it might be 2 or 3 years because they drive them a lot, right? Okay, so anyway, so the balance sheet tells us assets and
liabilities.
liabilities. What are liabilities?
Something that
From
you
where
owe.
all these assets originate?
You,
Resource.
no, whatever you owe.
It's what you owe, and it can be where many of the assets come from. Yeah, so it could be where you get the cash. In fact, probably, I hadn't heard it said that way, I hadn't read it that way, but that's an interesting take. Probably, yeah. Okay, so liabilities, well, not always, because it could be investment, right? It could be owner's equity. So you could have no liabilities often and lots of assets, right? Just owner's equity and assets. And remember, what's the formula for the balance sheet?
Assets equals plus owner's equity.
Assets equals liabilities plus owner's equity. Okay, so liabilities are what you owe. And you can have short-term liabilities, and those are liabilities, that's something you owe, and you expect to pay back within 1 year, right? Short-term within a year, so it could be for a few months up to a year.
But you said that equity, it's, yes, actually what I'm trying to say that equity is a source of asset as well.
Well, yeah,
I would like to
liability
say that
and
for-
equity
yes.
reflect sources, as well as what's in part of equity can include
Exactly.
retained earnings.
Yes.
So, sure, okay.
Because we use this equity in order to buy something, and
Mhm.
in case if you buy something, it turns into the assets.
Mhm. Okay. Okay, so we have talked about, well, we haven't really talked about owner's equity. What's owner's equity? Ultimately,
Direct investment from the owners.
starts out as that. What else is it?
Owner's capital.
Owner's capital, what does that mean?
Invested.
It's what's left over after you subtract the liabilities from the assets of the company, right? So remember, assets equals liabilities plus owner's equity.
The value of the stock.
Well, it's the value of what's left over in the company. So the value of the stock can be significantly different than the owner's equity, right? It can. In fact, there are companies that have negative, arguably negative owner's equity that have valuable stocks at times. We had some of that back in the 1990s, late 90s. Okay, so really, it's assets minus liabilities. The stock price can be, people will look at those, they will look at owner's equity, and that might determine whether they buy a stock. But what ratio do people often look at when they're thinking about buying shares of stock? Do they look at the balance sheet or do they look at the income statement? And they look at price to earnings ratio, right? That's the one a lot of people look at. Okay, so owner's equity we've talked about. We talked about assets and liabilities. Assets are what you own, liabilities what you owe. They're short-term and long-term in both. There's owner's equity. We talked a bit about the income statement. We've got revenue and expenses. What's the first ratio for a manufacturing firm or a retail type company or a distributor, a reseller? What's the first ratio most folks are concerned with on the income statement? Sales minus cost of goods sold, and that is what? What's that called?
Sales minus cost of goods sold, gross margin.
Gross margin, gross profit, gross margin. Some textbooks that we have here say gross margin is always expressed as a percent. Some say it can be an amount, a currency amount, a dollar amount, ruble amount. Okay, but sales minus cost of goods sold is a very important margin to look at. Gross margin is very important. Why is that? Because it tells you how much is left over to pay for the rest of the operating costs and to make a profit, right? You pay taxes and other things that you have to. So it's very important. So if your cost of goods sold goes up too much and you can't raise your prices, then maybe you don't want to be in that business anymore. And I mentioned last time that IBM looked at its lines of business and it determined to get out of its personal computer line of business because apparently their gross margin, at least that's what I read a few years ago, they didn't think it was that good. Hewlett-Packard decided, not so much because of gross margin, but because of the future gross margin, they decided to get out of test instruments a few years ago, and I read articles that they were selling off this division, which according to these articles was their first division that they had as Hewlett-Packard. Now, I'm not sure that they ultimately did it, because I didn't see any follow-up articles, but they were looking at it that way because they thought they could make more money in another business. And that's one of the things you need to be looking at is you're exploring business opportunities. So one of the first margins to be concerned with is gross margin, right? Okay, and then you have operating costs, and those include a lot of things. And we'll see that, we see some of the expenses. If we look at this handout for where do we stand, and we'll be using that today. On page 773, you'll see for the income statement, using the periodic inventory system, you'll see that they've calculated the gross profit. So they've got the net sales, which is sales minus returns and allowances and discounts and other things, right? They've got net sales, and then they've got total cost of goods sold. And they also tell you what the credit sales are over there as a note, as a side note out of the total. Okay, so the gross profit, net sales are 1.9 million plus, and gross profit is 915,000. And what that leaves is 915,000 plus to cover the operating expenses. Notice wages, salaries, mortgage payment, utilities, insurance, a lot of the standard stuff. Now, we'll see down here, depreciation expense. Is there any cash going out for the depreciation expense?
No.
No, there's not. Remember, because that's just an accounting process that reflects some of that cash that was already expended or liabilities that were already incurred. Okay. And then we see down here under other expenses, interest. And often the interest expense is separated out, and so are the tax expenses. So you can get a picture of, the company's operations overall. How's it doing before interest expense and taxes? If they had the cash instead of taking out liabilities and paying interest, how would they have been doing, right? Okay, so we've got the interest expense there, and then bad debt expense. And often companies will account for bad debt. They'll make allowances for bad debt. Either they know what they are or they estimate them. Remember that from your accounting class?
Do they write it off?
Sometimes.
Yes, sometimes.
Yeah. Okay. And so here what they've done is write it off. You're seeing that as an example. Bad debt expense is writing it off. Okay, and if they happen to receive it in the future, then they would have to reverse that out and take credit for that as revenue in the future, depending on the accounting system. Okay, so we see that for the income statement. We also see the below the income statement, the second half, we see the balance sheet for Henderson Paint and Wallpaper. We see current assets. What's the first current asset? Cash. Why? It's the most
Important.
Liquid.
It's the most liquid. Liquidity has to do with being able to turn something into cash, and the most liquid asset is cash. Okay. And then the next one we see is short-term investments, and those turn to cash pretty quickly. Okay. And then we see accounts receivable, and it shows here less allowance for doubtful accounts, so they build into that. So sometimes they'll have a separate line item for that on the balance sheet, right? Okay, but they've subtracted what they think will be accounts that won't get paid. So these are accounts receivable, and they're considered, everything we've seen up to this point is in the current assets is considered quick assets. Because the thinking is these can be turned into cash relatively quickly. And we see inventory here. What types of inventory are there? If you're a manufacturer, what types of inventory do you have? You have,
Goods.
well, you have goods, finished goods for sale.
Yeah.
You have
In process,
works in process and raw materials. So often what comes in is raw materials, and it moves into works in process, and then it moves into finished goods inventory, right? So 3 types of inventory. In this case, what they have is just materials that they're going to use, because this is a paint and wallpaper company. Okay. Then we have fixed assets, plant, equipment, other fixed assets. We see total fixed assets here. And then we see current liabilities. And by the way, their fixed assets have already taken into account depreciation, apparently. And it may be that this was the last year to depreciate anything, so there's no more depreciation showing up for some of these. Well, actually, that can't be the case, because they still have carrying value. So anyway, they didn't show you a separate line item for, these are net of accumulated depreciation. Okay, then we have current liabilities here. So we have accounts payable. What's that?
These accounts that we have to pay.
It's money you owe. Okay. Note payable. What's a note? When they talk about a note,
It's financial instrument.
it's a financial instrument. It's usually some kind of a loan instrument. It can be a note to a bank. It can be a note to an individual, another company. You know, it can be a lot of things. But it's something where you've signed an agreement to pay back a loan of some kind. All right. And then income taxes payable. And we also have long-term liabilities. So we've got long-term bonds, which means long-term is more than a year. Okay. And then we see total liabilities there, and stockholders' equity, and assets equals liabilities plus stockholders' equity. So those two numbers should balance. Now below on this sheet, you see some ratios. And we'll talk about some of these. You've got another sheet that tells you the formulas for these ratios. And how many of you have done ratios before? It's really simple. Okay. Did you do any ratios in your accounting class? There are some that are mentioned, and it just takes a couple of minutes, and you might have done them, you know, during the class. I'm not sure. Okay, good. Okay. So we see some ratios there. We'll be talking about the cash flow statement more extensively next time. So we're going to focus on these two statements today, and we'll get started building out to these today as well on Business Plan Pro. Okay, the first ratio we're going to look at starts on, well, a couple of ratios you're concerned about. Gross margin, talked about. Also net income, right? And so net profit margin. So as a percentage, you want to watch those. And you want to watch those, you can look at 2 or 3 years, and you want to follow those year on year. And sometimes what you'll do is set up common size income statements and balance sheets. Common size meaning you pick a number like sales that reflects 100%. So on a common size income statement, sales is 100%, and you divide every other line item by sales, and that tells you the relationship between sales and each line item. And so you can look year on year and see, for example, how your gross profit margin is, right? Is it increasing or decreasing? Okay. The first ratio that we'll talk about, though, is on 246, key ratios. And this is current assets, page 246. It's also right here on this worksheet, okay? So for the financial statement exercise, and that's current assets divided by current liabilities. Where will you find current assets and current liabilities? What statement? Current assets, current liabilities, balance sheet. Okay, so let's take, where do we stand? Let's take Henderson Paint and Wallpaper. Let's go to their balance sheet and calculate the current ratio. And just do it on this sheet. You're welcome to write your name on it. And get out your phones. By the way, what you'll see, I've been to meetings where we've had consultants that were helping with, from Deloitte & Touche or another firm, who were helping with valuation of a company. They were looking over a business plan. And while we were chatting, they had the financials out, and they were just thoughtlessly, I mean, without even thinking about it, they were going through and calculating the ratios as we were talking. So it's something that's very common. Yeah, 1.14 something. I've got 1.15 rounded. Okay, good. And so that means there are 1.15 times as many current assets as there are current liabilities. And what that helps you know is, can you pay for the current liabilities as they come due? That's an important ratio. Because if you can't, then you're going to need to come up with more assets, or you could wind up bankrupt. Okay. If you don't have, let's say you don't have enough current assets to cover current liabilities, if it becomes a negative number, or if there just aren't enough, if, let's say it's 0.68, then maybe your creditors are going to come and they're going to want to get paid. If you can't pay them, then you may have to declare bankruptcy.
Usually it's between 0 and
Hopefully it's between 1 and 2. So you want to have at least as many current assets as current liabilities, right? Normally. Now there's a number of massive companies who arguably are not in that position. And some of it's the way they value some of the assets that's just not truthful. In fact, there are companies with derivatives that where the derivatives are way overvalued. They're marked to model. They just create a number instead of marking them to what the market value of those derivatives would be. So they're fake assets. Okay, and then there's a quick ratio. And for a quick ratio, in this case, we subtract inventory. Why do we subtract inventory? Quick ratio is quick assets divided by current liabilities. Why do we subtract inventory from that?
Maybe because it's not so quick and not can be quickly converted to cash.
Right, and what happens if you try to quickly convert inventory to
there's
cash?
another-
Yeah, you lose the value, you have to discount it, right? So you've got, 3,000 cases of beer you need to, you want to liquidate. in order to pay off some creditors, chances are to get somebody to buy 3,000 cases of beer, they're going to pay less than market value for them. Okay. Okay, so go ahead and calculate the quick ratio.
0.45.
Right, 0.45 to 1. And depending on the industry, that may be okay. What's the industry average for those first two ratios on the last page? The industry, or median, not the average, the median. What does the median refer to again? It's the middle value, not the average, right? It's the middle value. So there's an equal number of population on either side of the sample. Okay, let's try speaking in English.
Okay.
Okay, so if you calculate...
0.45.
Okay, so if you look at the industry average for current ratio, the industry average, industry median, industry median is 1.7 to 1. Henderson is 1.15 to 1. So that may not be a good thing. You may want to get some more information about the company to find out why that's the case. And it could have been something that, you know, a usage of funds in recent times, or taking on certain liabilities for a good reason, because they've got a new contract or something like that. Okay. Quick ratio is 0.7 to 1, industry median 0.45 to 1. Yeah, also maybe a problem. So if you were looking at possibly buying this company, or if you were auditing this company, which you probably have no reason to do because it's too small, right? But if you were auditing, you might look at those and say, we need to find out what's going on here. Okay, the next thing we're looking at is some leverage ratios. When we refer to leverage, what are we talking about?
The possibility that the loan give.
Right, okay. You know, leverage has to do with debt in this case. So how much debt, what is the relationship between debt and some other factor? And in the case of the first debt ratio, what is the formula for debt ratio?
Total debt or liabilities divided by total assets.
Okay, so liabilities and debt are the same. Okay, so you're looking at the relationship between debt and assets, right?
0.57.
I have 0.43. Yeah. Okay, so what are your total liabilities?
526,135.
Okay, so 526,135 divided by total assets, 1,232,120. Okay.
143.
Okay.
0.4.
It's quickly.
Plus, okay.
Sorry. 0.43.
And the next one, you're looking at the debt in relation to tangible net worth or owner's equity. And owner's equity minus, now you don't have to do it for this, but tangible refers to subtracting intangibles. What are some examples of intangibles that might be intangible assets?
Software.
Well, intellectual property.
Goodwill.
Goodwill, absolutely. Okay, and,
Brand.
excuse me?
Brand.
Brand, which can be part of goodwill or part of, so yes, so those are intangibles. Okay, so those things have a value, and they can have great value one day and suddenly no value at all, right? Within a day, a new technology can make a current patent that's brought in billions of dollars is worthless. A brand can lose its value instantly, right? Arthur Anderson was a limited liability partnership, if I'm not mistaken, but still, that brand had great value. They were considered the gold standard, and in the early 2000s, their brand was gone.
Which one?
Arthur Anderson.
Arthur Anderson.
They crashed and burned with Enron.
Huh.
So they were the audit firm, and they were also doing consulting, and they'd set up some of the questionable transaction, or the questionable companies, shadow companies, arguably, that were involved in transactions that hid the real financial state of the company.
Not transparent.
I have a question about that question. Usually it's not expressed in percentage.
Well, you could, but normally it's debt to net worth, so it's something to one, right?
Because I think I already saw it expressed in percentage.
Okay, it might be. So it might be
Sure, I saw
43%, yeah, and it could be, and it probably depends on who's doing it. But it wouldn't surprise me that a lot of these that are expressed as a something to one, ratio is something to one often, but they can be expressed as a ratio, as a percentage as well. Okay? So total debt to net worth, okay, 0.75 to 1, or 75%. 0.75 to 1 is 75 over 100, right? Okay, the next one, we ready? It's probably a boring video, I think.
We're gonna edit
What we might be able to do is just cut a couple
Yeah.
of these and, edit a lot.
Because calculating the ratios, it's not very
Yeah,
exciting.
it's one-
No, it's not, it's quite
75.
boring. So, welcome back. We've done some ratios and on fictitious business. Now what we're going to do is build out some business plan financials, basically a budget for a fictitious business. This will be Beulah's Bistro. This is an exercise I put together to help undergraduate and MBA students learn some of the logic behind budgeting and also to learn how to use the software, which is again is Business Plan Pro. I spoke with the publishers back in California, in Oregon, different times, and they didn't have any exercises available, so I put one together. And I'll be posting this, I've improved it over the last couple of years, I'll be posting this on our website. If you can see errors or improvements, let me know as you go through this so I can clean it up, and I'll post it there. I also plan to send an email talking about our use of it over the last several years, the software, to Tim Berry, the publisher, who's a professor at University of Oregon, a great guy. We've emailed back and forth. So please find anything that's not right with it. So we're going to be doing business plan financial statements for Beulah's Bistro. It's a small restaurant located in an office building in a new office area. It's an area that had been a bit depressed in terms of occupancy for the buildings because of the downturn in the economy, but now with the upturn, there are new tenants who have signed leases or are about to. So they're anticipating an increase in the number of new tenants. This is a startup business. It competes with companies like Coffee House, Chocolatnica, Prime, small sandwich and sort of healthier food shop, Stolovia's, and some neighborhood restaurants. Most of the people that will come here are people in the neighborhood. They're in the trade area. This is not a destination that people would come from miles away to go to. Okay? Now you'll notice here on page 8, it starts with some general information, and you're going to be plugging some of this data into the tables here. Now, the first few pages show how to start up Business Plan Pro and get it set up to start entering data. So I'm showing you some of where we're going to enter data and just some of the functionality of Business Plan Pro to get you started. And I'll be in there with you to help you with navigating some of this. But I want you to notice the first table we'll be looking at is the startup items table, and it includes some items like legal costs, stationery, insurance, rent, promotion, and liquor license. These are included under expenses. There are also startup assets. Cash will be determined. Startup inventory is there for you. Other current assets will be zero. Long-term assets, you're going to get from the worksheet, which is just below this. You see the worksheet where it says Startup Long-Term Assets Worksheet right below that?
Yeah.
So you need to add those up. Now this startup worksheet, the worksheet, long-term assets worksheet is not part of Business Plan Pro. In a number of cases, you'll be creating detailed tables to show the numbers that you'll be entering into Business Plan Pro. Does that make sense? And you could do them, you could add them in Business Plan Pro and just link them. I generally just do them in Microsoft Word or in Excel if it's small, if it's larger rather. Small if it's Microsoft Word, Excel if it's larger, and then I just have them, I cut and paste them as tables later. Make sense? Okay, so let's look at this table. Here are startup expenses, and also I've calculated already cash required and startup inventory and long-term assets. Okay, and so I've done the numbers on that. Notice here that there are some different views. You can look at instructions. Row by row helps, so I can come to this row, row 18, and it tells me long-term assets, also called capital assets, plant and equipment. These are assets, right, which are subject to depreciation. So you can get help on some general concepts. There's also an outline view, which comes over to the side. So if you want to navigate around, let's say sales forecast. So here I've already plugged in the sales forecast numbers, so I can go to the spreadsheet, but there's not a lot of room there to work, so that helps me navigate, but I want to get rid of it, so I just go back up and lose the outline. Okay, and I've chosen here as a view full screen. Now it looks better on my screen, but it's the drivers have it kind of cramped for this particular projector. Okay, so we have, in this case, we're going to be doing a units-based forecast of sales. So we determine how many units we're going to sell of something. And in order to start this worksheet, we plug in a description of our units here. Notice that's blue. That means that is a cell that you can put information in. And I chose for the first month, startup month, January, 1,200 units of pastries, for example. Now, I started with that, and you'll notice we've got a sales forecast that starts on page 11. And I had the first month's volume as 1,200. The price without VAT is 150 rubles. Notice here I entered pastries under units, sales. Here it automatically filled in below for unit prices. And so here the price is did I say 150 or 140? Okay, I need to change that then, my mistake. Okay, so 140, and it calculates then my sales automatically. Notice it's black, so that's done automatically. And it gives me total sales. And I also include the direct unit costs, or cost of goods sold. In some cases, it's an amount. So pastry, it's 20 rubles. And that's estimated for flour and some of the direct costs that would go into it. And for business lunches, however, I estimated it was 25% of the cost of the lunch. So I plugged a percentage in there and it calculates it for you. Does that make sense? And so then it also, on the sales forecast, it calculates the total direct costs for everything and then total cost of goods sold. And if I navigate to, I can use this to navigate also. I like this best. I navigate tables to profit and loss. And I go to the spreadsheet. Notice there are tabs down here. There's an introduction that helps explain things. There's a table settings that tells you what some of your key tables are. So here, I want categories for my expenses. No, I don't want categories. In this case, our version in there, you can't do categories if I'm not mistaken. Then there's a wizard that can help you walk through this stuff. So you just do next task. You'll be doing a lot of next task. Other cost of sales, I don't have any. Okay, but I'm going to go right to the spreadsheet because I've already filled in some of this. And notice here, I've already got the sales at the top line. That automatically carries over. Direct cost of sales carries over. And then if I've got some other cost of sales, then I can plug that in. It's blue, so I can do that. You with me? Okay, great. Now, there are some things that automatically carry over. There are some other things where you're going to have to fill in. So for instance, payroll carries over from a personnel spreadsheet that you'll be filling in. Marketing and promotion, though, you're going to have to add. So you'll add, it's a line item, I believe it already exists, but you'll be adding the numbers for that. Depreciation, it's a line item automatically, but you'll have to fill in the numbers for it. Okay? How many of you have used Excel? Okay, are you pretty power users for the most part? Okay, good. Then some of this stuff you're familiar with. So I'm going to navigate back to the sales forecast. Look at the spreadsheet again. Notice here, I kept cost of goods sold and prices the same for the first year. What I did change was the volume of sales, so the unit volume. I started at 1,200 and estimated that there would be a 3% increase per month for the first few months for pastries. And then around May, they're expecting a big influx of people, of new tenants and stuff. Presumably some of them will come there. So I increased it to 6%. Notice the formula I use. It's equals this cell times 1.03. So the multiplier is, 100% plus 3%, right? 1.03. And then I was able to do this and drag it across for the whole year, and then right-click, fill right. See that where it says fill right? And for some of these, I think for a couple of them I had, 1.03. So initially I did one cell with that formula. I filled down, right-clicked, filled down, and then I selected both and I carried them both all the way across. And so it automatically filled in the formula all the way across. Everybody understands how that works? Very simple. Oh, okay, let me show you. See here I've got this formula, C19.
Yeah.
You understand that part. Okay, to fill across, and unfortunately you don't see so many cells, I'll just fill one cell across. I just do this, and I right-click, and see where it says fill right? So now it has the same formula, only the relationship is no longer C19, it's D19, right? Does that make sense? So you can quickly do this when you're doing your estimates for personnel. If it's the same from the first month through all the months, you just do the whole row of personnel numbers, and then you just select the whole row, drag it across, and then fill right. So boom, you're done. Very simple. I'll show you the personnel table here quickly. Okay, and I'm just going right to the spreadsheet. Notice here I have one manager, 2 assistant managers, a half-time bookkeeper. I should have put 0.5 there. 1 chef, 4 cooks, and this was based on the restaurant operating, I believe it was 105 hours a week. And you know, some people, what they do is they forget to take into account that there are shifts for some businesses, like restaurants and retailers, right? So in other words, you need more than 1 person as a waitress because people have to, you know, have time off and they have to go on vacation and stuff. Okay, so here what I did was I filled in, I totaled the estimated amount for each. I selected, and then I just went, selected, filled, went across, and I filled right. Okay? So it all filled in as the same. And then when I wanted to change, like to add 10% per year, or 5%, then I just went in there, did 5%, and for the next year, if I want to do the same the next year, I just pull it over and drag right. Right? Very simple. Okay, one of the things that's a bit different, how many of you have ever had a mortgage on a home or a car? Okay, on a house. So you know that generally as you pay down the loan, you're paying less interest per month and more principal, right? So we will talk more about the cash flow in general and the cash flow statement next week, but I wanted to show you that in this exercise, starting on page 9, for those of you that get that far, starting on page 9, we took out a long-term loan. We took out a long-term loan for 9 million rubles, and the interest is 20%. And on the next page, I have an amortization table. And what that tells you is how much interest is paid each month, how much principal is paid each month, and then the remaining balance. Everybody understand that? Mm-hmm. And notice how each month you're paying more and more principal, right? Because as you pay off some principal, that means that there's less interest to be charged. Everybody understand that? And that's how mortgages work. Now I'm going to take you that you're going to work with. Well, some loans you pay the interest like bonds. You'll pay interest the same amount of, generally the same amount of interest, and then at the end of a period of time you pay back the principal. With mortgages, generally you're paying down both principal and interest, so you pay both, right? And so each month, in this case, the payment is the same each month, but less each month goes to interest, and more goes to paying down the principal. Okay? All right, so with this, to fill this in, you're going to need to go to the cash flow statement. And I keep going to the cash flow. Notice the cash flow has cash in. So you've got the cash, this is all cash sales. Cash from operations is automatically calculated. VAT, you'll have to do this. You put 18% there, and it calculates VAT for you. And it adds the VAT, but it doesn't show up on your income statement or your balance sheet, because the month you collect it, you pay it back. So at least for purposes of this, you don't have any taxes payable on your balance sheet. Okay? And notice we go down here, it's got total cash received and also expenditures, and so this takes into account all your expenditures, which are considered cash for this, which is common in Russia. And so it's got what's spent on operations. Also, though, it's also got the VAT, which should match the VAT above. And then notice here, it's got an item for long-term liabilities principal repayment. You see the number there? 308,062. Do you see that on this amortization schedule? It's for January. So that's how much principal was paid down. And what happens in Business Plan Pro is it will look at how much principal is left and it will charge 20% interest. So it's not exact with this, but it's close. Okay, and for the end of this is paid off in 2 years. The end of the first year, what I did was I looked at the balance at the end of December of 201X, the first year. And then I subtracted that balance from the original 9 million that was 9 million rubles borrowed, and that tells me how much principal is left. And then I just wrote that off at the end of year 2, right? Because this only gives you 1 year for monthlies. Does that make sense? So here at the end of year 2, what was left in terms of long-term liabilities principal was $4,055,000, and it's not exact. The interest would be different because you're paying down monthly. Does that make sense? Okay, so you'll be doing that. Some of you might get to that point today. You see how to navigate this? Pretty simple. Some of the setup, often what people will do is they'll set up and they won't choose units-based. We want units-based for the sales forecast. So you'll have unit volume sales, you'll have cost of goods sold per unit, and then you'll have, then it will calculate the cost of goods sold and the unit sales. Sometimes you can choose, if you want to in the future, values-based, where you just plug a number in for the whole month. It's not based on units, but you should explain how you came up with that value. So here it tells you, it's pretty clear, it's got the detail in units, and you can explain why you think you might sell that many units. With values-based, you'd say, we think we'll sell $300,000 in pastries. Somewhere in the text, you should explain why you think you'll sell $300,000 in pastries, or 9 million rubles in pastries, or whatever it is, right? Okay. So the table settings you'll want to check sometimes. So in this case, no, I don't include a second year of monthly data. I want standard financials that plan cash flow. Payment delay 0. So you have no accounts payable. I don't need to track other income and expenses. You're not going to import from other programs like QuickBooks or something like that. So the setup that starts on the first page is important. What I'd recommend you do today is set up your spreadsheet, start filling in some of this data, the startup table if you can, get to the cash flow and fill in the loan amount, and then save it, email it to yourselves so you've still got it, and then we're going to pick up on this next time. Okay? Any questions? Let's go crank it up and see, let's make it work, okay? See what happens. I'll be in there to help you if you have questions. And what I do, this is a standard operating procedure, just walk through it step by step. By the way, I put 201X, obviously, it's just like accounting books. It just means a year, right? So for you, you might start, your startup might be 2011 or 2012 or 2013. It's up to you. Okay? Great. There we go. Remember to choose a financial plan, otherwise you'll have all the topics, and then we're focusing just on the financial plan. All the topics means all the... And work in pairs if you feel like it, if that'll help you help each other. Alone's fine. No. Just after you finish filling some of it in, that way you don't have to come out back and start over. Everybody understands, after you finish today, then email it to yourselves. Okay, so then you don't have to start over. When you finish, send it to your email and send it to yourself. I do that with everything, in fact, so it's always out there in cyberspace. If my flash drive or computer, they both die, then manage inventory. You will manage inventory.
Procedures just to understand the concept.
Well, this is your setting up your financials, what you're going to do in the future, and then from further on, you're going to start filling in the data for this exercise. And then you will learn how to use the software. Does that make sense? Yeah. Because in the past, when I've asked MBA and undergraduates to come in here and just, like in America, told them, learn the software, nobody did. 1 out of 30 people could figure it out on their own. So, and I didn't find any exercises online. The publisher said, we don't have any. They have tutorials that show you one part of it, but our students weren't going to that. So that's why I created the exercise, so within 2 hours, you've done most of the functions you'll use, okay? So please walk through and learn how to do it. Well, yeah. Do you understand? So you send it, you open your email account and you send it to yourself in your email account. And but you can open it here. You come back here on Monday, you open your email account, you open the down here, put it on the desktop. So all of those steps, always learn how to use the software. I just want you to be more than an audience. I don't want to be one. I want you to learn how to do something.
Just to get more familiar, to become more familiar with this software. So
And with business planning. No, this is business planning. He's thinking about the numbers.
Я тебе скажу тогда.
If everyone called well at least we will not have any difference. So
Well, just put your name, yeah, right.
okay.
Yeah, just put your name after.
Like this. Well at least
So look at what you need for a startup.
Startup
Far. Looks like you selected it, but I'm not sure. What are you concerned about? Okay. Yeah.
Here.
Somebody else. I often thought that's what Shakolabnitsa was probably trying to do with Starbucks, because they bought up all these good locations, which was typically what Starbucks would do. So I thought maybe they were trying to get bought. Doesn't appear. Okay, then there are sociocultural things. What are some, how about in the food industry? What are some things that are happening here related to food? Well, one thing is, excuse me?
Sushi.
Sushi, yeah, that's a big thing. And actually, it's gone down some, but there was just a boom in sushi restaurants. And I used to go to some of the few sushi restaurants here, and we'd have to wait in line to get in. You know, now it's not so much since the crisis, and I think people are concerned about contamination and stuff. But yeah, sushi was real big. Another thing I've noticed is Russians are buying a lot of packaged Western-style stuff. A lot of potato chips and a lot of stuff, and I like the taste of that stuff too, but it's probably not all that healthy, you know?
Yeah.
Russians are buying more fast food, so really, Russian people used to eat more raw foods, and the milk would come in and it was fresh that day. I don't even think it was pasteurized when they had it in the big containers. Okay, and I know some Russian people who are starting to go back to that. They're saying, I don't want this stuff anymore. I don't want the heart disease. I don't want the diabetes. I don't want all this other stuff. So I want to go back to some, you know, I want to start drinking raw milk and eat sheep's cheese. And
Are you speaking about Zitman market, right?
yes, and I love that market. I'm a regular. But I see a lot of Russian people in there. It's a very popular market. And so that's something that's new. They're not just doing Pentecostic. That's going on in America too. A lot of Americans want organic food. We don't want genetically modified foods, right? And so, in fact, there's a initiative going on the ballot in California to make it necessary to label genetically modified foods. Russians, for the most part, don't want genetically modified foods. You know, Monsanto's a company, they've got a right to be a company, but if I don't want to eat their products, I want to know what their products are in, right? Because nobody's really tested them. And we're sort of the test, apparently. Okay? So anyway, those are some socio-cultural trends. So what you want to do as you're developing your business idea and examining the industry, you want to look at not just these factors, these are just some generic things, but you want to find the things that are going to affect your industry, that might give some opportunities and threats to the industry. And sometimes a threat to the industry, it could be a political threat to the industry, that may be a benefit for one company. It may be an opportunity for one company. That happens a lot. So